Good evening, everyone. I'm Yamini Sood, and I warmly welcome each one of you to the DSP webinar, The Lies We Tell Ourselves. I thank you for spending time with us today. The eyes only see what the mind is prepared to comprehend. This quote by a Canadian novelist, Robertson Davis, is a truth we seldom realize. As humans, we have a natural tendency to harbor illusions that things are better than they really are, because none of us want our best laid plans to go haywire, do we? We tend to ignore evidence that has the potential to create conflict with our preconceived notions. And this reality shapes human behavior. It impacts everything we do in our lives, including our investment decisions. Popular narratives, consensus views, and following the crowd are the common pitfalls faced by an investor. And through today's presentation, we would like to unravel some of these lies that we like to believe instead of confronting the unpopular reality. And we will do this with the help of evidence and data, with focus on numbers over narratives. It gives me immense pleasure to invite Mr. Kalpen Parekh, President DSP Investment Managers. Kalpen is an avid lover of market history, human behavior, and has this profound ability to look at market cycles with stoicism. Let us try to learn how this helps him form investment insights, sometimes ahead of times, and how can this help us become a better investor. And before he takes over, I would like to mention a few things. Friends, this is a listen only webinar, and I request you to use the chat box wherein you can type the questions for Kalpen. We will try to answer them post the presentation. We have also prepared a feedback form which will pop up on your screen, and we shall request you to take the same. Your feedback is valuable and will help us improve in the future events. So with that, over to you, Kalpen.
Hello, good evening. Thanks, Yamini, for the introduction of the session. I'm told by my team that almost 1,500 people have, are likely to join this session on a Friday evening, and I hope myself and DSP we are able to make your time, worth the while on a Friday evening. We're also talking at a time when our portfolio returns in whatever we have invested are looking very good. While I can't predict the future, but as a company, as an investment firm, it is very important that we continue to express our ideas, our thinking, our thoughts with our larger distributor and investor audience, and share them with the highest amount of focus on evidence and data. Because what we've also realized is that investing is an emotional science, and we many times bring or over appreciate the emotional part of investing, and the evidence part of investing takes a backseat. So pardon me if you find too much of evidence and too much of data in what I'm trying to talk, but I feel it's important to talk at these points in time when past returns look very good, and we all know that past returns are not necessarily a prediction of future returns. So I will just connect my presentation, and we will start in a second. Yes. So I want to start with something connected to bubbles, something connected to botany, and something connected to the virus. So let's go back almost 450, 500 years back in history, when in Europe, in Netherlands, we are all aware. A lot of us have read the history of the tulip bulb, which was nothing but an ordinary flower, and Netherlands is known for that. We have seen a lot of Indian movies being made and songs being recorded with gardens full of tulip bulbs. And 500 years back, there was a very unique type of tulip bulb which actually emerged in the gardens of Netherlands in one particular pocket. And over time, it became so popular in those cities that everyone wanted to buy that particular type of tulip bulb. And what was the beauty about that bulb was it looked very unique. It looked very different than others. It had a combination of colors in it, and it became so precious, so expensive, so sought after, so popular that in that one tulip bulb, we could have purchased a list of all that you see on the screen. And let me read that out: 27 tons of wheat, and that's a very large amount, or 50 tons of rye, or 4 fat oxen, 8 fat pigs, 12 sheep, 2 hogshead of wine, 4 tons of beer, 2 tons of butter, 3 tons of cheese, a linen bed, a wardrobe full of clothes, and a beaker of silver. So, just one tulip bulb could have given us such a large quantity of so many things that were otherwise equally precious. And why was this happening? Because, the narrative that time was this is a very special flower, this is, very precious, and so on and so forth. Of course, like everything which has a story and everything which has a narrative, which becomes very popular, where all crowds go and chase, eventually, things settle down, reality dawns, gravity takes over, and the bubble actually bursts. And a lot of people really burned their fingers and lost their money. In fact, later on, when scientists and botanists, really were studying that, what was the reason for this particular part of Netherlands to have these type of flowers bloom there, they realized that it was not the weather of that city, or it was not the soil which was unique. It was actually a virus which has, which had infected the crop, and which actually created this type of unique flower. So a lot of these things were known only later on, once time passed, once prices corrected, the bubble burst, and a lot of people really lost money and earned a lot of precious lessons. And the same connection I want to take today, when we see the pandemic in which we are living right now, we are in the second wave. When the first wave happened, initially, no one would have thought, we will get it. In fact, I remember I was in Guwahati for a conference with one of our distribution partners. And when I came back, our chairman, Heminder Bhai, he in fact got upset at me. He said, haven't you been reading about, this virus which is gradually spreading around the world? And I told him that, why are you so afraid or so scared? It is something in China, and, we are far away in India. So how will one trip in Guwahati really matter? This was sometime, I think, in the month of January or February. And see what eventually played out. So we many times, ignore things that can happen. We underappreciate how things can spread and become large. And Corona is a classic example where a lot of us as a country, as nations, people have thrown caution to the wind. We hope that we have learned lessons from wave 2, and we don't let things get bad once the lockdowns get lifted and we normalize our life and start moving around. Because the thesis always is nothing can happen to me. Nothing that can go wrong can happen to me. This is the thesis that we've seen in life, we've seen during this pandemic, and we also probably presume that this cannot happen to my portfolio. This cannot happen to my investments. Market corrections, market will react. It won't happen to my portfolio. And that's the myth that we need to break and be aware of. We also realize, in investing particularly, like in life, that there is always a huge queue to hear lies which are very comforting, very reassuring, which connect with our own belief systems. But there is virtually no audience go and listen to truths which are uncomfortable and truths which are inconvenient to our belief systems. And it's a part of life. We've seen that whether it comes in terms of religion, in terms of politics, in terms of our preferences of sports stars or movie stars, or in terms of investing. So with that backdrop, I just want to highlight why is it important for all of us to keep asking this question, that at different points in time, once in every few years, asset classes become popular or unpopular. They become in fashion or out of fashion. And these things happen at the extremes, not on a daily basis. Otherwise, in the real world, prices keep moving in a very boring fashion. Markets keep moving in a very boring fashion. But at extremes, there are very, sharp reactions. So today we are again sitting in one way at a certain extreme where, after a 30-40% correction, we've seen more than 100% jump in prices. And many sectors have seen 150, 200, 300, 400% jump in prices. Stocks across the world are going up. A huge participation is increasing. And all of them can also become a nice, reassuring, message that the world is embracing long-term investing. The world is embracing equity investing. Don't worry, interest rates are low. Everything can be justified. So these are times to just pause and reflect that, okay, what makes sense, what doesn't make sense, and be sure that we are not the crowd. We are not the crowd which is standing in the queue of reassuring lies, and rather we are in the crowd, or rather a small group where we are dealing with the truth, however inconvenient it may be. Why is that important? It is important because history has shown that crowds rarely make money. Crowds do make money in the short term, but generally in the long term, crowds don't make the best of returns for their portfolios because crowds are more often late. And we are also part of that crowd many times. So with our learnings, we keep on refining them and evolving our thinking and sharing with people like you. And we have seen this is, data which has been published many times world over of various asset classes around the world. History since the last 20 years. If you take annualized rolling returns of each of these asset classes make money, funds make money, markets make money, but most often we have seen the investor, end up being below average in terms of our portfolio returns, purely because of being in the crowd. So the next few slides, I'll try to highlight, where are we seeing crowded behaviors and, what are the lies that we keep listening to. We sometimes, on our own, because of our own biases, tend to get carried away and, we tend to continue to, propagate a certain theory or an ideology or a philosophy. And it's time to constantly validate that, is this nice to hear? And hence we are believing in this theory. It makes us feel nice. It maps with our belief system, or constantly keep validating with data by seeking disconfirming evidence and asking the question, are we not becoming a victim of narrative fallacies? So let me start with the first data point. And then this has been a matter of huge debate, many years in the last few years across sectors, across countries, across markets. I just want to give some example. I want to start by saying that the price we pay does matter. Our thesis is what we buy is important, no doubt. The quality of the asset is important, whether it is a bond or a stock. But the price we pay also is very important. When prices are orderly or normal, this comment is not so relevant. But when prices are, reflecting a lot of perfection, lot of euphoria, it's very important to, just look back at data. And I just want to, I've seen a lot of debates these days about, valuations are not relevant, or, P alone is not important. And a lot of them are very valid point. But when we are buying the whole market, and especially investors like us who deal in mutual funds and, build portfolios, we are at large buying the whole market. We are not buying unique companies alone, or we are not buying just few sectors. We are aggregating these portfolios, which consolidate into a certain market portfolio. And when we look at some of these, overall market data points, in 2008, when market valuations, Nifty valuations were at 28 times, since that day till today, the return of Nifty, total return index, is roughly around 7% CAGR, which is just equal or slightly lower than what a simple high quality AAA short-term bond fund would have given. So at the extremes, valuations do matter. We should be conscious of that. Otherwise, over a long period of time, valuation effect gets normalizes, but at extremes, it does matter. In the same year itself, within few months, in September, the same market was available at 11 PE. Just, in those 9 months, if one had invested a little bit late, since then till today, returns have moved up to around 15% CAGR. We had a very similar repeat of the movie last year in 2020, when beginning of the year in January, again, overall earnings were priced at 29 times. Since then, our current returns are around 17%, though it's a very short period because we've had one sharp correction and then a sharp bounce back. Just around 16 months have gone since then. And within 3 months, when markets had come down to 17 P on 23rd of March, since that day till today, markets have gone up around 92%. So we've seen how, the price we pay is a very important dimension. Today, where are we? We are closer to 29 times. So when we are looking for very long cycle, next 5 to 10 years, what we need to be conscious of that, at large, these are not average valuations, these are above average valuations. So it's important just to ask this question that, is it likely in the next 5 years or next 10 years when I need my money back, can valuations be same? Would they be higher or would they be lower? It's a matter of probability. My hunch is that it should normalize somewhere, closer to its average and not consistently remain stretched. And there are some data points we'll share in the next few slides. The same equation, if we apply to fixed income as an asset class, again, does the price we pay matter? Let me show some data points here. The chart is a chart of the blue line is the composite bond index average 3 to 5 year maturity. And the gray line is the 3-year AAA corporate bond yields. So if you see this gray line, this is data since 2004 to 2009, roughly 2003 to 2009, the first cycle when interest rates actually went up again. So in 2004, AAA bond yields were at 5% like today, and they actually rose to 13% in the next 5-6 years. Because in 2008-9, when the GFC happened and there were large credit worries, bond yields temporarily spiked up. So 13% is an abnormality, is an exception. Ignore that for a moment. But 9 to 10% is a range where eventually bond yields settle down. And in those 5 years, the returns of the CRISIL Composite Bond Fund Index were 3.2%. On 2004, in 2003 and 4, October, when someone would be investing in a bond fund or a debt fund, the last 4-year returns were very high double digits, 17 to 18%. In fact, I remember my father forced me to redeem from my guild fund investments at that point, and he forced me to buy a house because I had just got married, and he said you need to have an asset. So take this money out and invest in whatever small property we had to take. And then in the next 5 years, we've seen a cycle like this. Today, as we speak, again, AAA bond yields are closer to 5%. It's important that somewhere in the next 3 to 5 years, one should keep in mind that rates could rise and would rise. And have we prepared our portfolios and designed our portfolios keeping that reality in mind? Now, let me delve into some data points on some of these operating metrics or our economy, and some good companies have seen that recovered back in the last 6-8 months, and the trend is very positive incrementally, where good companies are consolidating, they're cutting down expenses, their margins are at lifetime highs, and you're seeing very sharp profit growth coming back. But again, as we talk, the market is also now starting to discount that this may not be permanent. This was one-off. But even if you go back before COVID happened, if you look at the last 10 years, on one hand, we have constantly heard about we being the second fastest growing economy in the world. Is partly a truth, but is also a great narrative. And I would want all of us to constantly ask questions when we are exposed to data points with a lot of adjectives, which make us take investment decisions. So while we were touted to be the fastest growing economy on earth or the second fastest around the world, and which from a data point of view is fairly true, but see the impact of that on corporate earnings or on return on equity. Over the whole decade, ROEs have actually halved. And then it's not just a one-time effect, it is over the whole decade. Over 10 years, it's been a continuously trending downwards trend. Are we aware of that? And it doesn't mean that this will continue. This also calls for reversion to mean for things to improve at some point in time. But what I'm only trying to highlight is recognize always what is the narrative and what is the number along with that narrative. A balance of these two will help us be better investors and take the right decisions. Now convert this into profitability growth. So if you take Nifty 500 and the rolling 5-year earnings growth of these, I'm taking rolling for 5 years, not at one point in time. So, in 2010, the last 5-year earnings growth was 11 or 12%, but that continuously kept trending downwards, barring a brief patch in 2013-14 when profit growth was around 8 to 9% at an aggregate level. Eventually, today we ended the last decade with around closer to early single-digit profit growth rate, roughly around 4 to 5% in rupee terms. Now, these are all cycles, and cycles will inflect back. We will have seasons like this. But just be conscious of that, because when I reflect back the journey of last decade, I realized that a lot of these numbers were perhaps subdued while the narrative was far more stronger of strong growth rates, recovery, revival, and so on and so forth. And then the same got reflected in valuations because stock prices did not trend down. They continue to remain stable or rising upwards because of surge in liquidity, because of no other asset classes being as scalable or which could absorb so much of money coming in an easy way. World over, generally valuations have moved up. So after being flat for some time, they've been trending upwards in the last 4 or 5 years. So if you notice in 2020 and 21 recently, valuations are very close to where they were in 2007, 2008, and 9. So these are the data points of how broadly the landscape looks like. Now, one way to justify this is low interest rates are also a great input to justify high valuations and say that, okay, high valuations will remain for long. They've remained there for quite some time in many countries. So why should not that be the case here as well? And also the fact that low interest rates will trigger a huge growth in earnings. In some pockets, it does wherever companies are able to take benefit of low interest rates, reduce their cost of capital or borrowing costs, or when they are heavily levered, and on the other hand, their assets start producing or generating cash flows. So in some pockets it will happen, but when one cannot take it for granted. And here we just want to show the correlation between inflation, interest rates, and earnings growth. In fact, again over the last 10 years, we saw that the 5-year earnings CAGR has trended downwards. Even the 5-year inflation has trended downwards, and so has interest rates. So when interest rates go down, in a way, rates are discounting the future. That future growth rates also should be slower, and that is why interest rates are also lower and remaining low for some time. One can argue the other way around, that because rates are low, future earnings will be higher. But this is what data, at least for the last decade, for our country and our market shows. And there is also a question one can ask then, that if that being the case, why are Japanese equities, for example, not trading at infinite multiples? They've had now almost 25, 30 years of zero interest rates, and their growth has not recovered. Their valuations have not gone to the sky. It is only in the last couple of years that the Nikkei has started generating superior returns, but it has been a long phase of average returns or below average returns. So one way of looking at this is, if interest rates are low, the discounted value of future cash flow is high, is one way to look at it, is a comforting way to look at it. Ask this question, can it be misleading also? If you actually run long-term data series and correlation and causation, that are low interest rates also hence discounting a slower future growth rate for profitability and earnings. So the truth will be somewhere in between. Don't get trapped on any extremes, that because rates are low, multiples should be high, or because rates are low, multiples are high. There is a very big nuance in these words and statements. So both these statements, depending on what your view and stance is, one can take that call. But just be conscious of that just one dimension is not necessarily a guarantee condition for valuations to remain stretched and remain high. Then we looked at US market for long history, because they have history for 55, 60 years of interest rates and market returns. And we have looked at this data since 1965 till 2010. So we broke down interest rates in four quartiles, first, second, third, fourth quartile, fourth being higher rates and first being lower rates. And then we said that whenever interest rates were in the lowest quartile, what was the next 10-year returns in their markets broadly. And typically what data reveals is that actually the next 10-year returns were higher from the high interest rate quartile. And on the contrary, the next 10-year returns were lower once interest rates had come down and remained low for quite some time. So the correlation is not exactly what sometimes we are made to believe. And be conscious of that low interest rate does not guarantee that the future rate of returns will be significantly higher, because there are many variables which will matter. Valuations will matter, earnings growth will matter, quality of earnings will matter, and how different sectors are behaving. And finally, liquidity and flows will matter. So just be conscious of these things when you're forming your opinion. I just want to bring a disclaimer somewhere in between. The idea here is not to scare any one of you here or to say things are bad. But when things are euphoric in the environment, I just want to at that point in time counter-cyclically just highlight that what are the data points that you should always look at, and be more prudent and pragmatic in your portfolio construction and even in your advice when you're dealing with client money. Also, another comfortable lie that we hear is, in the long term, returns are always good. No doubt, more often, but it also matters that it is possible only when you don't start with very sharp drawdowns in the early stage of your investments. So today, this is a very important point I want to share with all of you, because we are seeing massive explosion and expansion in more and more money coming into equity as an asset class, whether in stocks or in funds. And then, thanks to the digital world that we have in India, and thanks to a great UI UX on mobile application. It just takes 2 clicks to start opening up a mutual fund folio or a stock account folio or a demat account. So a lot of investors are coming in at this point in time. Now, what is important is also again look that there are countries which have gone through cycles of development before before India, and in those countries investments done at cycle peaks and then having immediate drawdowns, such investors have had to wait for very long periods of time to generate superior returns that equity as an asset class should deliver. If you're going to earn 7 or 8% in equity over a long period of time, then it is like earning a fixed income return with volatility of equity. The idea is we should earn 1.5 to 2 times over a long period of time and significantly earn real rates of return over what fixed income or what inflation gives. But if you look at Dow Jones 29 to 54 or 25-year stretch of poor returns, just because the next 3 years had a very sharp fall in the market. So someone who invested at the bottom of the cycle in 32 would have really made significant money. But someone who invested towards the peak of the cycle in 27 or 1936, 37, their long-term returns were muted or below par. The same happened with Japan. That's an example we've all studied. 30 years and waiting, very, very long phase of consolidation. And the 40,000 number has just now, come closer to reach. Otherwise, it's been a very long phase of poor returns. Obviously, the last decade belongs to companies with, strong balance sheets, very strong cash flows, strong brands globally as well as in India. But here we are just taking an example to highlight that quality companies, no doubt, will continuously, consistently compound their profitability, their cash flows, but not necessarily the stock price at the same run rate if, again, we end up overpaying for that. So it's very important to balance, what price are we paying for what we are buying. So if what we are buying is good, it should not get cancelled out by paying obscene prices. We have seen ourselves in our portfolios at times where we've liked companies a lot. They've executed very well for 8-10 years, and we continue to hold them, but we then navigate or calibrate the weights to respect the fact that their valuations have run up a lot. But some of the best brands in the world, the most iconic brands, which were great brands 50 years back, are great brands even today, have also gone through long periods of correction and drawdown. So be aware of that. The other important thing I want to highlight is, there are times we always read or hear about some sectors becoming permanent or becoming, perennially large, or secular stories through themes or labels like financialization of savings is a big trend, is a mega trend, which will trigger the mother of all bull runs, or the Make in India story will ensure that the so on and so forth. No doubt, over time, some of these things will happen from a profitability point of view. But if those themes are already overpriced in your portfolio, then the returns that we will make in our portfolio will be fairly suboptimal. And also, in extending these themes for too long and taking them for granted, what we many times miss out is the shift in regimes where sector leadership starts changing from one hand into other. So we saw that in 2000, where the sector leadership was everything digital globally as well as in India. But over the next 10 years, that leadership, gradually transitioned into the manufacturing, infrastructure, engineering, and the core sector space. But while in 2008, 9, 10, when that became the talk of town, as if that is the reason why India will become bigger than China and stuff like that. But that sector leadership eventually transitioned into the hands of pharma companies. Pharma companies became very large, and then after that to financials. Today, financials are very large. So we were just doing this exercise, and then this data will look starkly a bit more different again when we do it for 2021 once all the results are captured in our data points. But while banking is the largest weight in the benchmark, but profitability was not the largest. Now some of it will come back once the PSU profits start getting added back. But at least for the last 4 or 5 years, the profitability was far more volatile compared to the narrative and the story that the sector got. On the other hand, we have sectors like healthcare, or sectors like metal, for example. Last 2 quarters would be blockbuster in terms of earnings growth, cash flows, and if metal prices remain where they are, the next year or two, they can see higher weights building up in portfolios or even in benchmarks. So, just be conscious of these things. Don't extrapolate narratives. and blindly buy into them. Now I want to just come to few other one of the most popular trend currently in the market, which even at DSP we are very strongly advising or encouraging, is global diversification or international diversification. In fact, DSP launched its first international fund in 2007. So we've been in this space for 13, 14 years now. Ironically, it is picking up pace only now. The month of April, 2 months back, the largest selling product category was the international fund category. So we are seeing a lot more interest in large as well as small investors wanting to add global diversification to its portfolio. Now, if done for the right reasons of bringing lower correlation asset classes into the portfolio and building it from a long-term perspective, it's absolutely the right thing to do. But it's if done because the last 5-year returns have been much higher than Indian markets, then it could be disappointing. And I just want to call that out by showing this data here. The purple line is the rolling 10-year return rolling for the S&P of US, and the blue line is the rolling 10-year return for Nifty of India. If we go back in 2007, 8, 9, 10, when we launched our international range of products, the 10-year return of Indian markets were in the band of 15 to 30%, 15 to 25% CAGR, in spite of that 2008 correction and slowdown after that. So almost 15 to 20% CAGR when you looked back. And in the same phase, as you can see in the red box below, the 10-year return of US markets was in fact almost zero or even negative for some, we used to say it is a lost decade, and see why India is the future and why more and more money should come to India. So US markets almost for 4 or 5 years had 10-year returns, decadal returns less than 5%, and Indian markets in the same phase had returns 4 to 5 times higher, between 15 to 25% CAGR. Now that gradually started shifting since 2013, 14, and 15. And if you notice how the blue line trended downwards and the purple line has trended upwards, and now they've actually become mirror image of each other, but in an opposite manner. Now in recent times, 2016 to 2021, the purple line has hit 20%, 15 to 20% boundary in that band, whereas the blue line has moved down to the 5 and 10% band. Now, more and more money is chasing international investing, possibly also looking at these last 10-year returns and assuming that this will continue. None of these are predictable, perhaps, but it is important to be aware that these are cycles which will keep changing. Don't get blindly trapped into any one side and get over allocated to any one theme, whether in global markets or in domestic markets. So just be conscious of that. Themes are secular only at its high points. That's when the story starts building up that India is a secular story, emerging market is a secular story. Today's story will be that technology is a secular story. Technology will impact all companies in the world, all sectors in the world. No doubt it will, but it is also getting reflected in the price extensively today. And a lot of these businesses and the prices at which they leave very little room for any disappointment or any change in the economic environment in the next 5 to 10 years. So this is a very important dimension. I'm not making a case that one should not invest globally. We should. In fact, we very recently launched a fund with 33% exposure to global investing. So we are firm believers of global diversification, but just be conscious of the fact that there are cycles, and where are we in that cycle at this point in time. This is another favorite one. 2021 has been a defining year where people like me from the fund industry, and I'm sure all of you, have become very popular in our friend circle. Almost there is no single day which passes without a friend calling up saying, "Paisa lagana hai, kahan lagana chahiye, which is the best performing fund?" Or some of them have already Googled and identified that these are the 3 best performing funds or stocks or PMSs, and we want to invest money there. And then when I ask them that for how long do you want to invest, or what is your objective or what is your return expectation, you get very surprised and even scared at times that the return expectations are very different than what we rationally would keep. What I want to highlight here, this is an example of one of our oldest fund with a history of 24 years now. It was called DSP Equity Fund. Now it has got renamed as DSP Flexi Cap Fund. 24-year history. I have taken in this chart rolling returns for a 5-year horizon. Anyone who has invested for 5 years at any point in time, what were the rolling returns? Now, what does this show? This shows so many ups and downs in terms of direction. There are times returns trend up, and then there are times when returns trend down, and there are times for 4 or 5 years returns are just stagnating. So we all who are in the markets know that returns fluctuate. In the long run, they trend upwards, but till they reach there are journeys of flat markets, correction in markets, and then rising markets. So we have to be very conscious and aware of this. These are not straight line products. These are not equity is not a high return version of fixed deposit where the CAGR comes to us every year. It is obviously going to be lumpy, and there will be years of very poor returns. Now, if you notice here, what this shows is there are periods where average 5-year returns were less than 5% or 10% or even zero. And there are years when 5-year returns were as high as 60% in the boom of 2006 to 8. In fact, someone was telling me that era of 2003 to 2007 is what made so many careers and made so many people rich. We wish and hope that in our careers we see something similar where markets in 4 years went up between 7 times to 15 times. And that's why the returns also inflected so much. But after that short phase, if you take that phase out of Nifty or Indian markets, the long-term returns on a rolling 5-year basis have been in the band of 8% to 20%, and temporarily in periods of panics come below that. But very important for us to be aware that we cannot extrapolate what has happened in the last 3 or 5 years, whether badly or in a positive way. If past returns are very high, don't extrapolate that in the future. And even if past returns are very poor, don't run away from a fund or an asset class and move out. So one of the biggest lie that we believe in is that your fund's past return is going to be my future return. Never is the past good or bad return equal to our future good or bad return. They will always have cycles, and they may disappoint us if we are not aware of it. So let's be aware that returns will rise and fall. We have to take it in our stride and not take them for granted. Another lie which we keep telling ourselves and we believe in before investing is that we are all long-term investors. But when I look at data for the last 23 years of our unit creation, data shows that the average holding period is roughly around 32 months. So roughly around 3 years is the average holding period. So compounding never happens. We don't let compounding happen because in every 3 years the cycle changes. We get disappointed and we take money out and move to some other asset class or never come back to equity as an asset class. It has happened with our investors, with ourselves, and we sometimes end up making same errors in our own portfolio construction. So just I'll give you another data point. Our flexi cap fund completes 24, 25 years in the next few months, and you'll be amazed. I think the fund's long-term return would be somewhere around 20%, around 6 to 7% long-term alpha. Forget the long-term alpha because those type of alpha I don't think probably are likely to happen again for the industry. But even in the last 5 to 7 years, alpha is around 2 to 3%, which is not bad. So the total number of investors that we have in the fund who have stayed through the whole journey is less than the tenor of the fund. I'll repeat that statement. The total number of investors in the fund is less than the tenor of the fund. So that's the reality of our investing world. That most of us end up being very short-term investors and not let long-term compounding happen and not let our wealth creation happen. Now, why does this happen? When you analyze that, why is it that we all know the truth, right? That markets are volatile, asset classes have volatility, they have cycles. We know all of it, and we've seen this for so long now. Yet, why is it that we are not able to stretch investors for long-term? Basically, it is intermittent volatility and fluctuation because our minds are wired to think linearly. We don't acknowledge the phases in between when we don't make money or we don't make returns. And this is something that I learned, few years back, that, before investing, the first thing that we look at is the past. That, okay, what was the last 5, 10, 15-year return or the last 1, 2, 3-year return? For a moment, let's look at whatever is that asset class, whether it's fixed income or real estate or gold or global markets or Indian markets or a sector or a stock. For what was the phase for longest period of time when the fund did not make money or the asset class did not make money. So if we can prepare ourselves in our mind that wherever I'm investing, there will be a phase where for X number of years I will be disappointed either because of NAVs falling or NAV is going nowhere and just consolidating, how will I react at that point in time? Am I ready for a phase like that? If I'm not ready for a phase like that, then maybe I'm not the right investor for that asset class. Nothing is wrong with the asset class. Nothing is wrong with that fund or scheme. But I, as an investor, am not ready for phases of zero returns, because we assume it to be our birthright that NAV should go up every day, stock prices should go up every day, or every month, or every quarter, or even every year. Why so? 99% investors, if we were to survey them and ask them that, do you know equities for 2 or 3 years sometimes can give zero return, most of them will say, no, I don't know. I think it is a 12-15% compounding asset, so it should always give 12 to 15% compounding. So it's very important to try this exercise before investing in any asset class. And for how long can it give me either zero returns, negative returns, or less than fixed income returns? Because our opportunity cost is 5% or 6% fixed income yields that are prevailing today. And I did this exercise for Nifty and Nifty Next, which is the top 100 companies. In our career history in the last 20 years, this data would have looked very different for someone who invested in the 93 peak, when for almost 10 years returns were zero. But let's say 2008 to 2013 was a phase when point-to-point returns were zero. Now, when something like this happened, what made money? If we are able to find those answers, we can actually build our portfolio for the future, keeping some of these variables in mind. That when equities didn't make money for 6 years, 6 long years, earned zero return. In fact, if I would have added another condition for how long did it earn less than fixed income, this number of 5 years would have got stretched to around 7.5, 8 years. But let's stick to this example. In this phase, what else did well? Could I have still made some returns? Could I have still done better than fixed income or same as fixed income? There were some investments which did that. So an SIP in both these indices earned around 6 to 7% return. And obviously an equity fund would have earned 1 to 2% more because of the excess alpha or the higher return that it would generate. So when lump sum can give flat returns, SIPs can actually give more because it takes advantage of acquiring more units intermittently when markets go down or go through time consolidation. In the same phase, asset allocation funds and hybrid funds generated superior returns. So something like our dynamic asset allocation fund or dynamic asset allocation fund as a concept delivered 8% CAGR in this period of around 6 years. And of course, it was ready for the next cycle between 2013 to 16 that the country and the stock market witnessed. Something like a Berkshire Hathaway. I'm just using Berkshire Hathaway as a name, as a proxy to very common sense way of investing, and also as a proxy of global diversification. That delivered 14% CAGR. Global Value Index, which is MSCI World Value Index, that delivered 11% CAGR in rupee terms. These are all rupee returns. Gold delivered 18% CAGR, and obviously bonds delivered 6% at that point in time. So now it could be very different in a different regime where global value could give 0, gold could be 0, bonds could be 4, and stocks could be 7 or 8 or 10%. But what I'm trying to highlight is there can be long phases when different asset classes will behave differently, and hence locking money only in one asset class is not the right thing to do. Comforting lie will tell us that let's buy what is doing very well right now, what has done very well in the last 1 year or 3 year or 5 year, whether stocks or sectors or categories or asset class. We get comforted by the recency of last 5 year returns. But it is very important that we don't over allocate to very high past performance, especially in asset classes which have very high amount of cyclicality. Now, what do we do then? How do we really build our portfolios? Knowing this background, knowing the reality that we are at largely higher bands of valuation, at lower bands of interest rates, in a phase where there are doubts on whether inflation is transient or is it likely to become permanent. Whether inflation will rise, whether interest rates will rise, whether valuations will come down. A lot of these are unknown unknowns, and keeping that in mind, I would like to highlight that there is another lie that gives us comfort that if you are a high concentration investor, you are a high conviction investor. Many times, high conviction investing is harmful, especially when there are too many moving parts and when all asset classes have really moved up and risen a lot. So one framework that we encourage or we advise our advisors and investors is to break down investing into 4 buckets and then take a call depending on which bucket makes more sense to you in terms of your lifestyle, your needs, your appetite for risk, as well as your opinion and view of the future. So one bucket is, steady income generation, which is fulfilled by your bonds and, dividends, cheaper companies which can continue to give reasonably high rates of dividend. The second component is asset growth, which obviously is the entire bucket of equity funds, whether domestic equity or global equity. Here I'll add one more nuance. I have heard so many people say that, large caps are safe, mid caps are risky, small caps are more risky. International funds are safe, Indian funds are not safe. Index funds are safe, active funds are not safe. These are all equity funds. Ultimately, all equity funds carry equity returns and equity risk. So when there will be volatility, small cap and mid caps will also take as much hit as global stocks, as much as Indian stocks. But that's the growth bucket. Then you have the volatility cushion bucket, where you're not taking any interest rate risk, or you're not taking any valuation risk. So it could be money market funds, floating rate funds, overnight funds, very low maturity, low duration funds, which will just give you the current coupon or the carry, but ensure that there is no impact to capital, and which can be used again to invest when the asset growth bucket goes through volatility and price correction. And then there are long short funds, which are again very interesting products that you must learn if you have not studied, because if we believe that one side of the market has become very extreme, then how do you make money? By going on the other side. So there are enough hedge funds which have evolved in the last 5 years in India, and last 5 years have seen all the ups and downs and volatility, and these funds have proven themselves through these 5 years. So today, versus earning 5% in fixed income, if I can get a hedge fund after its inefficient taxation delivering 7 to 8% also at 1/4 the volatility of equity, it can be a very interesting addition to our portfolio to reduce our correlation and increase the Sharpe ratio of the portfolio. So just be conscious, how can some of these interesting products add value to the volatility hedge bucket. And the fourth bucket is the inflation hedge bucket. A lot of us have forgotten what is inflation in the last 5-7 years, but this year has seen bounce back in inflation. There can be opportunities in the commodity space, or companies which are beneficiaries of inflation, especially commodity prices rising, and food prices, energy prices, gold prices. So that can be another bucket to look at. Now, while I've given you these 4 buckets, but if someone were to say, give me one answer, I can't give you that one answer, because each investor's need is unique and personal, and which is why having a coach, having an advisor can help a lot in deciding how do I construct a portfolio in each of these buckets, and what type of stocks or bonds or funds do I add here. And obviously, along with that, continue the journey of learning how each of these buckets interplay with each other. What are the correlations? What are the causations? And how do we really mix them? Many people think that having 40 funds is diversification. No, but instead having 4 funds can also be a meaningful diversification if it is done right. Now, a lot of people, Nassim Taleb has made a very interesting comment in the spirit of skin in the game. He says that most experts in the money industry, world over, always give views and opinions, but they never say that what are you doing about it. So, in the spirit of the same, skin in the game or transparency, I'm just taking his quote more seriously and highlighting that how am I constructing my portfolio today, and trying to highlight what is the power of low correlation mix. What is the magic of multiple asset classes coming together if you want to build a long-term portfolio with lower fluctuation and volatility. And I've just taken the last 7-8 years data, which has significant amount of volatility, because it's important to show the data of the current regime and not the past regime. So this is my current portfolio allocation basis my needs, my near-term cash flows, my desire to purchase a house, which could mean a very large cash flow component, which I have to keep immune from the volatility of long-term asset classes. Keeping broadly that backdrop in mind, my asset allocation is 30% in short-term bond fund, 10% in our gold mining fund and the sovereign gold bond that Reserve Bank comes out with every second month. Around 15% is in international stocks through a series of our international funds. So I have not taken specific funds name, but I've just taken a proxy index to that particular asset class. And around 45% is in Indian equity funds, which are invested across flexi cap or quality as a style, or natural resources, which is commodities. So a mixture of all of that. So that makes up this 100. What is the beauty here? Here, if you see below the chart, the light gray color gives the return of each asset class. So two asset classes have given very low return in this period of 8 years, 7 years. Gold is 8.1 and the short-term bond index is 8.4. Now today 8.4 looks very attractive because current yields are at 5%. So the next 5 years won't be 8.4, they will obviously be around 5 or perhaps even lesser than 5. But two asset classes, which is 30 and 10, 40% of the portfolio, earned returns around 8%. Global stocks earned around 13% and Nifty also earned 13%. But the combined portfolio delivered 12.7. Now, if you were to do a mathematical average of 8 plus 8 plus 13 plus 13 and divide that by 4, the actual return mathematically should have come somewhere around 10.5. But instead, the actual mixture, which is my asset allocation, comes to 12.7. So whenever a mixture's return is higher than the mathematical average, that means that the correlations are working favorably or designed favorably. And that's where a lot of work towards identifying low correlation and where the cycle is becomes very important. So this is a very important point here. No doubt, just investing in Nifty 500 would have given the highest return of 13.3 versus the asset allocated return of 12.7. In fact, if you notice, the orange line or the yellowish line has always been largely below Nifty. So it means as an investor, I would be living through constant phase of relative underperformance to Nifty. But in periods of drawdown, it makes up or catches up for everything. And over a long period of time, gives you the comfort of not losing too much of capital and stay invested. I think half the game is won if we just stay invested and don't interrupt our compounding. And the reason to blend portfolios like this is to ensure that we don't interrupt our compounding and we remain long-term investors to take benefit of long-term asset classes. After the entire presentation on using data and evidence, I want to end with emotion. This is a small 1-minute video, from my favorite movie, Three Idiots. It's an iconic movie. A lot of you would have seen it, and it's a recent popular video which was circulating on WhatsApp. I want to correlate it to the fact that how these are moments where envy and fear of missing out is making a lot of investors take risk which they are not ready for or which they are not aware of. And that can be harmful to our portfolios. So envy is our biggest enemy, and the envy of others making money hurts us a lot more. Let's see how in this movie they've explained the same thing very quickly.
It is not audible, Kalpen.
So I want to end by just extrapolating the last statement that दोस्त पैसा बनाए तो हमसे ज्यादा पैसा बनाए तो हमें बहुत ज्यादा दुख होता है, and we need to stay away from the envy of others making money and ensure that we continue our journey of investing. Hello.
Kalpen, actually the video was not audible. It was just visible. It was not audible.
Oh, is it? Okay. Let me just try once. I'm sorry, I'm told that the video is not audible. So let me just try it once. Just give me a second. Just give me a minute. It's a very interesting video, so I don't want to end. Just give me 1 minute. I'll do it again. The audio sharing option is already there. Let's see if it works again. Just confirm to me, Yamini, once if it's working.
Check it. Reach it.
Is it working now?
Yes.
Okay. Enjoy the video.
Last. और तेरा? Second last. Rancho? नहीं है यार. दिल बैठ गया. इसलिए नहीं कि हम लास्ट थे, पर इसलिए कि हमारा दोस्त फेल हो गया था.
There is a mistake. It's not possible. It's injustice.
साला ये साइलेंसर इतना चिल्ला क्यों रहा है यार?
Second है.
साला. फर्स्ट कौन आया?
Rancho.
ह्यूमन बिहेवियर के बारे में उस दिन हमने कुछ जाना. दोस्त फेल हो जाए तो दुख होता है, लेकिन दोस्त फर्स्ट आ जाए तो ज्यादा दुख होता है. हम दुखी थे, लेकिन हमसे ज्यादा दुखी दो और लोग थे.
So I'll end by just saying that we sometimes do feel sad if we don't make money or we temporarily lose money, but we feel more upset when someone else makes more money, and we don't realize that someone else is making more money either because of luck, randomness, his skills, his risk appetite. Each of these things are very different. Our investing has to be our own personal choices and not governed by what others are doing. While we aspire to ensure that we earn reasonably better, stable, long-term returns, but let's not ever be under envy of someone else making higher returns and losing our sleep and taking wrong investment decisions, getting greedy at the wrong end of the cycle, or getting fearful at the wrong end of the cycle. With that, I just want to highlight, if there's a lot of content like this that we keep putting out on our social media handle, which is @DSPMF. People who wish to follow, please do so. And I'm done for the presentation. We'll be very happy to take questions now. Over to you, Yamini. Thank you for being patient to listen to me.
Thank you, Kalpen. Before we move ahead with the Q&A round, we'd like to pause for 30 seconds. And may I request all of you to help us with your feedback, please? A feedback form would have popped up on your screen. So if you can just pause for the next few seconds. Okay, great. So we've received a lot of questions, Kalpen. I'm going to ask you most of them.
Sure.
There's just one question which I think I can easily answer on this spot is like, can we know the DSP FlexiCap funds CAGR since inception? So that's 19.6%. It's almost 20%. That's the CAGR. There's another question where probably later on we could use our app and Kalpen take up. Somebody wanted to know the performance of active funds versus benchmark. So maybe we could show that versus with the chart tool. But while you do that, I'll move on to the first question is, how is the outlook for debt mutual fund investment? And do you think that short-term and floating rate mutual funds are more suitable during this time?
See, I've highlighted my view by sharing my portfolio very transparently. All my fixed income investments on an average have a portfolio maturity of around 1.5 to 2 years, which is a reflection that a lot of easy phase of returns is behind us because interest rates have come down in the last 5 years from 9 all the way down to 5. And this is also a phase where there is huge amount of liquidity. Reserve Bank has kept 8 lakh crores in daily liquidity in money markets. I remember a few years back when this number used to be negative, where liquidity was actually negative. From there, we have turned to 8 lakh crores positive as a measure to support the economy and keep liquidity going in this phase of opening up after COVID. And all of that has led to interest rates actually coming down. Now, if there are two assumptions one can make, rates going down from here, then longer duration portfolios will make sense. The other assumption is rates going up from here, then lower duration portfolios will make sense. And if rates remain constant, then something in between will make sense. So my our view as a house and my own view as well is that I would be less greedy when past returns are 2 times of current interest rates. So last 5-year returns or 8-year returns in bond funds have been between 9 to 10%, which is almost 2 times of prevailing current portfolio yields. And uh, the next few years will be characterized by governments, wanting a lot of capital to invest back to get economies to start growing back. Either they will invest through more capex or they will give more money in the hands of customers. But whichever way, and this is what we had seen after 2008-9 also, where interest rates bottomed out at 4.5%, 5%, and then eventually started turning up. So my odds would be to say interest rates will rise in the next 3 to 5 years, and hence I would recommend running moderate or lower duration portfolio. Now, how do you build moderate or lower duration portfolio? There are concepts like roll down funds where you buy a 2-year fund and then let the maturity come down. So as rates start rising, your portfolio's maturity is constantly coming down and reducing interest rate risk with every passing day. Very recently, we introduced a fund called the floater fund, where the net duration of the fund is around 2 years. So once the rate cycle turns, we believe that should happen anytime over the next 12 months. Now, whether it will happen tomorrow or 12 months later, I don't know. We don't have the ability to time it so perfectly fine. We hope we get lucky. But our thesis is it should happen 1 year down the line. But it also means that, whatever is the volatility associated with the 2-year duration will get reflected even in the floating rate plan. But if your time horizons are 2, 3, 4 years, these products will, help you a lot to transition from a very low interest rate regime to a high interest rate cycle without significant impact on your NAVs, without significant impact on the volatility of your NAV. So I would say that anything which is in the bucket of 6 months to 2 years is a good bucket for someone who has a rising interest rate view. We come from that camp. If you are in a camp that rates will not rise, then there are 3-year, 5-year, 7-year, 10-year buckets also to participate. But I would be in the first camp.
Okay. There are many questions on the current rally of equity markets. So
yeah, before that, Yamini, just in the spirit of extending what I spoke during the presentation, which is reversion to mean and past returns don't necessarily become your future returns. The first question you asked me was on the return of FlexiCap fund, which was 20%. But remember one thing, the odds of earning 20% return at 30 times multiple are very, very low or almost unlikely. So just be conscious of that. These are all past returns. So for someone to earn these 20% return, he or she should have invested in 96, 97, when in the whole year put together, the mutual fund industry would have not collected even 50 crores of equity funds. So equity was an unknown asset class at that point in time. Our parents were investing in fixed deposits and insurance policies, not equity was a bad word. So for someone who invested in an asset class which was a bad word then, has earned 20%. Today the asset class has been discovered, it is already fully mature. So future returns will be far more moderate than what you've seen in the past. Yeah, next question.
When demand destruction is so high, do we think that equity returns can sustain the momentum going ahead, or do we expect a deeper correction?
Yeah, I think we have seen a very deep correction very recently, just around 9 months back in March last year. And what has that done for all companies, let's say including all of us, right? We have focused a lot on saying that, okay, while demand will take its time to come back, though we as an industry are far more fortunate because savings in the hands of investors has only gone up in the last 1 year, and we continue to get flows. Mutual fund flows are very robust and dominant, but in many sectors demand has slowed. But companies have cut down on expenses and costs and ensured that profitability has come back. What I think in the last 5 years, India has gone through its phase of slowing demands. But a lot of companies have become better at the cost of weaker companies or fragmented companies. And in every sector, 3 to 5 companies have become very strong, who continue to still grow in spite of the sector demand being slow. And such companies will do well. And there are sectors like automobiles. Demand has been constantly trending downwards in the last 3-4 years. And the best of names, which were the marqueest names in 2017-18, have given negative returns since then till today. So there will be sectors where demand slowdown will continue or get accelerated, and those businesses will take its own time to generate superior returns. But remember, at some point in time, even prices reflect and adjust for slowing demand. Because if you and I know that demand is slow or getting reduced, then the market also knows. So to some extent, it starts getting reflected in stock prices, and it gets adjusted and priced in very well. And at the same time, there are sectors like healthcare was going through a long phase of slowing demand globally between 2015 to 2018. And in 2015, nothing could have gone wrong with that sector. We all used to say the most defensive sector. Promoters were coming on the front page of magazines as the icons of corporate India and stuff like that. And within 3-4 years, demand destruction happened. Market caps fell by 40-50%. So in a very defensive sector also, stocks came down. And then 2018-19 onwards, with marginal uptick in demand, and then COVID-led narrative fueling pharma as the next sunshine sector, the sector got re-rated. So I think it will be a balance of what price are we paying for the nature of demand. There are sectors where demand is rising or volumes are growing. Cement, we are seeing that. Manufacturing, it's happening. Engineering companies, it is happening. Select consumer companies, it is happening. Companies which are supporting homes and construction of homes, their demand has improved in last many years. And on the other hand, there are sectors where there is a slowdown, and this has been true every year in every cycle. We rarely have a phase where if all stars come together, like it happened in 2003 to 2007, where everything went up. So, which is why I mentioned that the need to spread out, diversify, and identify pockets where even if demand is there, it's not overpriced, will become very important. And on the other hand, sectors where so even and as an investor, of course, sometimes it doesn't matter. Even if demand is not there, how do we care? If on the other hand we can make money because some companies are in supply constrained sectors and they are able to increase their profitability and they are available at cheap prices, we can capture those opportunities also. And that is the reason I highlighted that diversify, expand, broad base your portfolio dimension.